Most traders believe the same lie. If you want to make more money, you need to trade bigger. Bigger position size. Bigger risk. Bigger reward. It sounds logical. If you risk more, you make more. But that thinking is exactly what keeps most traders stuck. Because trading bigger doesn't increase profit, it increases pressure. And pressure destroys execution. When you trade small, something powerful happens. Your brain stays calm, your decisions stay rational, your execution stays clean. But when you trade big, even slightly bigger than your emotional tolerance, your psychology changes instantly. You don't notice it at first. You still tell yourself you're following the same strategy. But internally, everything shifts. Your heart rate increases. You stare at P&L instead of structure. You move stops slightly because it's too much money. You close winners early because you don't want to lose open profit. You hesitate on valid setups because the risk feels heavier. The strategy didn't change, the size did. And size changes behavior. This is what most traders ignore. They think the key to scaling is confidence. But confidence doesn't come from size. It comes from consistency. When you trade small, losses don't shake you. You can take 3 losses in a row and still think clearly. You can follow your rules without emotional distortion. You can let trades reach full target without interference, because the money at risk doesn't threaten your emotional stability. And emotional stability is the real edge. Let's be honest. Most traders don't blow accounts because their strategy is terrible. They blow accounts because they increase size too fast. They win a few trades. They feel momentum. They double their risk. Then one losing streak wipes out weeks of gains. Why? Because the mind reacts differently under pressure. You may believe you're disciplined, but discipline is tested under discomfort. Small size creates manageable discomfort. Large size creates manageable discomfort. Large size creates emotional urgency. Urgency kills compounding. Here's something most people misunderstand. The goal in trading isn't to make the most money today. It's to build a process that survives long enough to compound. Compounding requires survival. Survival requires controlled risk. Controlled risk requires emotional stability. And emotional stability is easier with small size. When you trade small, you're training execution. You're building muscle memory. You're reinforcing discipline. You're collecting data. You're proving to yourself that you can follow rules consistently. That consistency builds statistical confidence. And statistical confidence scales properly. When traders jump to big size too early, they skip the foundation. They haven't proven execution stability yet. So when pressure increases, behavior collapses. Small trading is not weakness. It's strategic restraint. Professional traders understand this deeply. They don't think in terms of how much can I make. They think in terms of how much can I stay consistent. Because staying consistent is what allows size to increase safely. Let's look at the psychological mechanics. When you risk an amount that feels heavy, your brain shifts into protection mode. Protection mode focuses on avoiding pain. Avoiding pain leads to closing winners early, holding losers early, holding losers longer, second-guessing setups, overmanaging trades. Your edge disappears, not because it stopped working, but because you stopped executing it properly. When you trade small, your brain stays analytical. You evaluate structure, not money. You focus on process, not outcome, and process consistency is what creates predictable results. There's another hidden benefit. Trading small allows you to experience variance safely. You see how your system performs during losing streaks. You understand its drawdown behavior. You learn patience. You build tolerance for temporary losses. If you experience that same variance with oversized risk, you panic. You shut down. You abandon the system. You never let the edge play out fully. Small size protects learning. Big size interrupts learning. And if you interrupt learning, you interrupt growth. The traders who eventually scale successfully are the ones who stayed small long enough to stabilize. They didn't rush. They didn't chase ego. They didn't try to prove something. They built discipline first. Money second. The hidden power of trading small isn't about profit per trade. It's about stability per decision. And stability compounds. In the next part, We'll go deeper into how trading small builds long-term wealth faster than trading big ever could. Let's go deeper. Most traders believe bigger size equals faster growth. But growth in trading doesn't come from aggression. It comes from control. There's a major difference. When you trade big, you're trying to accelerate results. When you trade small, you're building infrastructure. And infrastructure is what supports real wealth. Think about this. If you can't handle 5 small losses calmly, how will you handle 5 large ones? If you hesitate when risking 1%, what happens when you risk 3? Size magnifies personality. If you are slightly impatient at small size, you will be extremely impatient at big size. If you move stop slightly at small size, you will completely destroy risk rules at large size. Money doesn't improve discipline, it exposes weakness. That's why traders who scale too early often implode. They feel good after a few wins. They increase risk. They feel powerful. Then variance hits, and suddenly their emotional system can't handle it. The problem isn't the system. The problem is emotional tolerance. Small trading builds emotional tolerance safely. When you trade small consistently for months, something powerful happens. You detach from P and L. You stop checking your account every few minutes. You stop calculating what the profit means. You start focusing on execution quality. That shift changes everything. Execution quality becomes your metric of success, not money. And once you measure yourself by execution, consistency improves. Consistency builds expectancy. Expectancy builds long-term returns. But here's what most people miss. Trading big often reduces expectancy. Why? Because emotional interference increases. You cut winners too early because the open profit feels large. You widen stops because the loss feels painful. You avoid valid setups because the risk feels uncomfortable. You overtrade trying to recover faster. Every emotional adjustment reduces edge, and small adjustments compound negatively. Over time, your performance becomes unstable. Now compare that to trading small. You enter trades calmly. You let targets hit fully. You respect stops automatically. You don't feel urgency to recover losses. You don't feel pressure to make the day back. Your decision-making stays consistent. Consistency increases statistical accuracy. Statistical accuracy increases net profitability. Small trading protects your process, and your process is everything. Let's talk about compounding. Compounding doesn't require massive gains, it requires consistent gains. A trader who grows an account steadily with controlled risk will outperform someone who swings aggressively and frequently resets to zero. Small, steady growth beats volatile growth long-term. Because volatility in behavior destroys compounding. Here's another truth. Trading small removes ego when the numbers aren't dramatic. You're less likely to feel invincible. You're less likely to show off. You're less likely to believe you've figured it out. That humility protects you. Ego is expensive in trading. Small size keeps ego quiet. Big size, inflated ego leads to overconfidence. Overconfidence leads to rule breaking. Rule breaking leads to account damage. And then you're back to rebuilding. Small trading also teaches patience. You don't need to double your account in a month. You don't need to dramatic screenshots. You need stability. When you focus on stability, you make better decisions. Better decisions accumulate, and accumulated decisions create growth. Let's break something down clearly. If you risk too much per trade, your drawdowns become emotionally destabilizing. Emotionally destabilizing. Emotionally destabilizing drawdowns cause strategy abandonment. You never let your system reach maturity. You stay stuck in cycles. Small risk keeps drawdowns manageable. Manageable drawdowns keep you in the game. Staying in the game is the real advantage. Because the trader who survives long enough develops depth. Depth in execution, depth in understanding, depth in discipline, and depth in discipline, NG later. Most traders want to scale first and stabilize later. That order is backward. Stabilize first, scale second. Small trading is the stabilization phase. It's where you build identity, not as someone chasing profit, but as someone managing risk. When you truly understand risk, you stop viewing small trades as insignificant. You view them as controlled repetitions. Repetitions build mastery. Mastery builds confidence. Confidence built on repetition scales properly. There's no shortcut around this. You either build slowly and sustainably, or you build fast and collapse. The hidden power of trading, small, is that it protects your psychology while strengthening your edge. And protected psychology is the foundation of real profitability. Now let's talk about something most traders completely misunderstand. Speed. Everyone wants to grow fast. Fast profits, fast scaling, fast results. But in trading, fast growth is often disguised instability. Small trading feels slow, it doesn't create dramatic daily numbers, it doesn't give you explosive screenshots, it doesn't make you feel like you're crushing it. But what it does is far more important. It builds durability. And durability is what allows acceleration later. Think about this carefully. If you build a house on weak foundation, adding more floors makes it collapse faster. If you build a strong foundation first, you can scale safely. Small trading is foundation work. When you trade small consistently, you build pattern recognition without emotional interference. You learn how your system behaves across different market conditions. You experience winning streaks, losing streaks, sideways markets, high volatility environments. And because your risk is controlled, you observe these conditions calmly. Observation creates depth. Depth creates understanding. Understanding creates precision. Precision increases expectancy. Most traders try to increase profits by increasing size. Professionals increase profits by increasing precision. Small trading sharpens precision. Large trading pressures precision. There's another factor most people ignore. Energy. Emotional energy is limited. When you trade big, your emotional energy drains quickly. You feel exhausted after sessions. You feel mentally heavy, you overthink. You hesitate, you feel pressure even outside market hours. That's not sustainable. Small trading preserves emotional energy. You can trade consistently without burnout. You can review calmly. You can improve without panic. That longevity creates compounding. Let's talk about math for a second. If you grow your account at a stable 3-5% monthly with controlled drawdowns, you will outperform someone who grows 20% one month and loses 30% the next. Volatility destroys compounding. Small size reduces volatility in behavior. Reduced behavior volatility increases. Reduced behavior volatility increases consistency. Consistency drives compounding. Now let's address ego directly. Many traders resist trading small because it feels insignificant. They want to feel progress. They want to feel momentum. They want big numbers to validate effort. But validation is emotional. Compounding is mathematical. Small, controlled growth over time becomes large. The problem is most traders don't stay stable long enough to see it. They sabotage their own progress by increasing size too early. Let's be brutally honest. If you double your account in 2 weeks, you probably didn't build skill. You built exposure. And exposure without emotional maturity is dangerous. Small trading allows skill to maturity is dangerous. Small trading allows skill to maturity is to disjumper. That order matters. Another powerful benefit of trading small is that it teaches you to separate identity from outcome. When you risk too much, each trade feels personal. You feel good when you whiz, and you feel bad when you lose. Your mood tracks your P&L. That emotional tracking creates instability. When you trade small, the emotional swings decrease. You start measuring yourself by discipline, not profit. Did I follow my rules? Did I respect my stop? Did I execute correctly? That mindset builds professional identity, and professional identity creates consistent execution. Consistent execution creates stable performance. Stable performance allows scaling. Scaling with stability creates real wealth. Small trading also improves recovery time. When losses are small, recovery is easier. You don't feel urgency to make it back. You don't increase risk out of frustration. You stick to your plan. And because you stick to your plan, the edge plays out. Most traders don't fail because they lack an edge. They fail because they never let the edge play out long enough. Oversizing interrupts the edge. Small trading protects it. Here's something subtle but powerful. When you trade small, your attention shifts from money to mastery. You focus on getting better. You refine entries. You improve timing. You analyze mistakes objectively. When you trade big, your attention shifts from mastery to money. You focus on outcomes. You become defensive. You protect ego instead of process. And protecting ego is expensive. Mastery builds wealth. Ego destroys it. Small trading encourages mastery. That's why it's powerful. In the final part, we'll bring this all together and talk about when and how you should scale safely without destroying everything you built. Now let's talk about the part most traders care about. Scaling. Because eventually the goal isn't to trade small forever. The goal is to trade small long enough to deserve trading big. That difference matters. Most traders try to scale based on emotion. They have a good week. They feel confident. They increase size. But confidence built on a short streak is fragile. It collapses the moment variance appears. Proper scaling is not emotional. It's structural. You don't scale because you feel ready. You scale because your data proves stability. Months of consistent execution, months of controlled drawdowns, months of rule following without deviation. Here's the truth. If your process changes when size increases, you scaled too early. If your heart rate rises significantly, if you start checking P&L constantly, if you hesitate more, you weren't ready. The purpose of trading small was to build behavioral stability. If stability disappears when size increases, you skipped the foundation. Scaling should feel almost boring. It should feel like a small adjustment, not a dramatic leap. If increasing size feels dramatic, it's too much. Size feels dramatic, it's too much. This is where discipline becomes real, because you will be tempted. You'll see someone posting large profits. You'll think, if I just doubled my size, that thinking is ego talking. Ego wants acceleration. Discipline wants sustainability, and sustainability wins long term. Let's talk about wealth. Real wealth in trading doesn't come from one massive year. It comes from consistent performance repeated over time. The trader who makes steady controlled returns for 5 years will outperform the trader who swings wildly and constantly resets. Small trading protects long-term survival. Long-term survival enables long-term compounding. Compounding is quiet. It doesn't look impressive daily, but over time, it becomes powerful. Another hidden advantage of trading small is clarity. When the numbers aren't overwhelming, your mind remains analytical. You evaluate trades objectively. You review mistakes without defensiveness. You improve incrementally. Large size often creates emotional blindness. You justify errors because admitting them feels expensive. Small size makes honesty easier. Honesty accelerates improvement, and improvement compounds just like money does. Let's bring this together clearly. Trading small does 4 critical things. It stabilizes psychology. It protects the edge. It builds discipline. It preserves longevity. Longevity is the real advantage. Most traders don't fail because they lack intelligence. They fail because they lack time. They blow up too early. They burn out too quickly. They quit before skill matures. A small trading extends your timeline, and timeline builds mastery. Now, here's something powerful. When you truly understand the hidden power of trading small, you stop feeling impatient. You stop feeling behind. You stop feeling like you need to prove something. You operate calmly. You build quietly. You improve steadily. And when you finally scale, you do it with control. You don't jump from 1% risk to 5%. You increase gradually. You test your emotional response. You monitor execution consistency. You treat scaling as a process, not an event. That mindset protects everything you built. Because the biggest mistake traders make isn't starting small, it's abandoning small too soon. They mistake small for insignificant. Small is training time. Small is foundation. Small is stability. And stability is profitable. If you can trade small flawlessly, you can trade big safely. If you can't trade, big will expose you. The hidden power of trading small isn't about staying small forever. It's about building the version of yourself that can handle bigger size without emotional distortion. Because in the end, trading isn't about how much you risk. It's about how consistently you execute. Execution builds returns. Returns compound. Compounding builds wealth. and wealth built on discipline lasts. So the next time you feel the urge to increase size, ask yourself, have I proven stability? Have I mastered small, or am I chasing acceleration? Because the traders who truly succeed understand this simple truth. Big profits are built on small, disciplined decisions repeated over time. And those decisions start small. That's the hidden power. Now, if you want next